Okay, I think we can get going. Hello, everyone, and welcome to our panel on global capital flows. I'm Scott Church, senior partner here at Rede, based in New York, and pleased to be leading our discussion today. This is perhaps remarkably our first time dedicating a session at RedeConnect to this topic, considering it's one everyone seems to be quite interested in. We thought it would be particularly topical for you now when we're seeing some significant pools of institutional and family office private capital coming online across the globe, including from regions or segments where GPs have not previously spent much time. The idea is to share with you what we're seeing in terms of capital flows for private markets, including private equity and private credit, and how we are going about accessing them. So we've allocated about 45 minutes for our discussion and want to make it interactive. So please do send in your questions using the Q&A function on your Zoom. And we'll reserve some time towards the end to address as many as we can. And please, start sending those as soon as they come to your mind. Don't wait till the end. Before introducing our panel members and diving into the subject at hand, I wanted to provide a quick update on our business here at Rede, if you'll indulge me. This gives you an overview, starting with our global office network. And the news here is that it's expanding. We've announced 2 new office openings in Dubai and Los Angeles, which will bring us to 6 total offices, including London, New York, Hong Kong, and Amsterdam. In the last 12 months, even as conditions have remained challenging, we were able to produce some great results from a diverse group of international investors, from every region contributing meaningfully. And this only happens through a dedicated group of people, our 40-strong team of coverage professionals with skills required to build trusted relationships with investors in every region. Worth mentioning, we work hard on culture, one that emphasizes teamwork and collaboration, with full transparency of information and active management, which we think are critical to achieving results for our GPs. Now, let's move on to the topic at hand, and I'd like to have everyone introduce themselves of the panel. I'll start with you, Christina.
Hi, everyone. I'm Christina Vedugan, partner in our London office, co-head of our global coverage team, and responsible for Europe. Alex, over to you.
Thank you, Christina. I'm Alex Bazarewski, partner in our New York office, and together with Christina, co-lead our global LP coverage team with, of course, a day-to-day focus on the Americas. Charles?
Thank you, Alex. I'm Charles Wan. I'm based in our Hong Kong office, where our regional headquarters is, and I am part of our global coverage team, heading Asia.
Thanks, Charles. I'm James Reller, a partner in our London office, soon to be based in Dubai. I'm responsible for the Middle East.
Great. So let's dive into it. In a recent analysis of new capital flows we did here at Rede, the Asia Pacific and Latin American regions really stood out. Like to ask what market dynamics are fueling this, and let me start with you, Charles, on Asia Pacific.
Yeah, Scott, thank you. Asia Pacific really has been robust and liquid of late. The outbound capital flows from Asia into US and Europe have been much stronger, especially post-COVID. This has really been driven by lower allocations from Asian LPs into Asia itself for a few reasons. Asian LPs have high existing exposure in the region already, and they're still digesting growth and venture exposures, which unsurprisingly have delayed distributions. So this is driving increased allocation into US and European markets, seeking for more stable and higher rates of return. And mid-market buyout is a popular destination. Interest rate increases have also been an alluring factor, particularly in US dollar credit. For example, the Korean markets have devoted a large amount of capital into private credit last year and still continue to. In addition, new Asian LPs are coming into the private markets for the last couple of years, and this is a critical growth factor. We've seen an influx of asset managers, insurers, and family offices who previously hadn't participated in alternatives, driving larger allocations into alts. That represents a completely new flow of capital in the market. So that's a point of excitement for us. And the movement to higher allocations in alts is being provided across multiple LP types. And that's probably because global public markets haven't fared as well in the last couple of years, leading CIOs to consider increasing allocations towards a more endowment model. So, for example, in Southeast Asia, across Malaysia, Indonesia, Thailand, right now, a new sovereign wealth fund is being set up. Another major government pension fund is just now getting set up. They're setting up their alternatives programs. And we've also been working with them closely to set a foundation for their strategic asset allocation. And yet another sovereign wealth fund has been setting up and begun investing overseas for the first time in the last 12 to 18 months. It's been endowed with capital, and their mission is to increase onshore investments in the country. And so collaboration with them for overseas investments where they will invest should you set up a presence in the country is highly favorable. So there's really a lot of excitement in outbound capital flow from Asia Pacific. And just a last point on Asia Pacific itself this year, there's been improved capital flows into Asia. Our own Rede Liquidity Index has shown that this has moved up a couple points. And particular areas of excitement is around specific geographies like Japan and India, taking up much attention from commitments to China. And a new phenomenon we're seeing is stronger Middle Eastern capital flows into Asia. China in the last couple of years itself, and then more recently this year, we've seen stronger capital flows into Southeast Asia. And there's speculation that the Islamic thematic is really driving these capital flows. So, and then last but not least, Chinese capital flowing into Southeast Asia, in part due to geopolitical ties, but also that Southeast Asia is now dubbed as the China Plus play for private equity. So hopefully that gives a good viewpoint on Asia Pacific flows.
Super interesting. Thanks, Charles. And I guess, the other interesting and quite exciting development we've seen south of the border here from the New York point of view is in Latin America. Alex, do you want to comment on that region?
Yeah, absolutely. Thanks, Scott. So over the past 3 to 5 years, Latin America has become a much more interesting market for private capital flows. Why is this the case, you might ask? I'd say sort of 2 reasons. One, well, each country in Latin America is actually very different culturally, from a regulatory standpoint, languages, accents, all of these things. One commonality is that all countries actually have quite young populations, with sort of significant embedded growth in investable AUM. Number 2, Latin American LPs are becoming increasingly sophisticated in their manager selection, and many have now built sophisticated teams to match. Now, that said, it's important to note a few key distinctions by country. So today we're seeing Mexico and Chile as the most active markets, and I'll give a little bit of color on each one. So Chile is the Chilean market is sort of dominated by 4 key AFPs, otherwise known as pensions. These in aggregate total to about 200 billion in AUM. The exciting development for the AFPs earlier this year is that the regulator actually increased the target for alternatives in these portfolios by a meaningful amount. It is important to note that these pensions do require GPs to have a 10-year track record, 2 billion in firm AUM, and an expected total expense ratio of less than 2.35%. Meanwhile, in Mexico, the pensions also are a dominant player here. And in fact, there are also 7 key pensions, or as they call it, Afores in the region. Those Afores total to about 330 billion of AUM. The interesting dynamic here is that up until 2018, these pensions were basically completely banned from investing in foreign alternative investments. In 2018, this changed and of course opened up portfolios mainly to sort of the US and European GPs, but also selectively in Asia as well. This market is characterized by being tight-knit, and it often also works with consultants. It is notable that Mexico is also home to several large family offices, some of which are based in New York, some in Miami, some in Chicago. There's a large family office market representing Mexican capital as well. Now, the markets we see as active, but less active than Mexico and Chile are Brazil and Colombia. In Brazil, we see several sort of active family offices, but it's important to note that pensions are still banned from making international investments in alternatives. In Colombia, there are also some active players. Notably, there are 4 pensions that historically have actually been quite active. The notable item right now, however, is that due to regulation, these pensions are actually feeling much more sort of pinched from a liquidity perspective. The other markets, there are sort of pockets of capital, but just sort of generally speaking, sort of less active overall. I guess sort of 2 final points, Scott, I'd make on sort of getting capital from Latin America. One is that most LPs in the region prefer to see consistent performance over several fund series. So therefore, it's a bit more difficult of a region for GPs that are earlier in their life cycle or have had more inconsistency in their track record. Number 2, relationships matter a lot in the region. So our very best advice here is take time to build these relationships and don't think you can just sort of fly in and fly out and get the money.
So the other region that's getting a lot of attention in recent years is the Middle East, as the secret's been out for a while now that there's lots of capital in the region. That said, many GPs have expressed frustration in their lack of ability to actually capture it. So James, what's your recipe for success?
That's very true, Scott. There's certainly been a flock of GPs heading to the region in recent years. And with sovereign wealth funds in the region having assets of around 7 trillion and deploying around 100 billion in private markets each year, it's actually easy to see why. A few observations I'd make. Capital from the region doesn't come easy, and it's certainly not for everybody. Unless you're a GP in your 3rd or 4th vintage, targeting upwards of 2 billion, have a very strong realized track record and net IRR, and deliver significant and importantly, sizable co-invest, the odds are somewhat stacked against you. Really understanding what LPs are looking for is key, and that's something we spend a lot of time on here at Rede. LPs are very heavily solicited in the region, and it's important to be able to show that you understand their needs. To put this into perspective, one LP I was talking to only a few days ago said to me, I've got 60 GP requests every week asking for meetings. It's therefore imperative that you really focus on what's important to them. You need a few things to be successful, and I can break this down into 3 core areas. First and foremost, the region is all about long-term relationships, that's obvious, but building these thoughtfully takes time. Institutional LPs in the region are very highly sophisticated investors, and it's not a great look to turn up and expect capital when you haven't dedicated time to the region before because you didn't need to. You really need to plan ahead and think carefully about how you approach different LPs. It's also not good turning up every 3 months without anything new to say. This is one of the gripes that LPs often bring up to me, and particularly if there's no immediate fundraising on the horizon. Instead, I recommend focusing on going to the region when you have key bits of portfolio news, tailor your approach as you ramp up towards fundraising, and make sure you target the right LPs with the focus of your product offering. I'd also say the GCC is a region that comprises of 6 distinct countries, of course with a common Arab identity, but with their own unique cultural and social differences. And understanding these is also important. Whilst we don't have time to go into all the nuances here today, an example is that Saudi is generally more formal in terms of communication style versus perhaps Dubai, which is a little bit more relaxed. Tailoring your approach certainly helps. Secondly, spending time with LPs and understanding what your focus is and what's important to them. LPs are very time poor. They have a lot of opportunities on their desk, and you really need to package things up so you're highlighting the key points that are relevant to them. If you do that, you're more likely to be successful. The final point I'd make is for the larger LPs in the region, there's often a transactional element at play. Having the right co-invest in the right sector, in the right thematic, at a point in time when they are looking for that, is something that will hopefully turn a speculative opportunity into something that could be actionable. You really need to think very strategically around these opportunities and use them and use in your portfolio and pipeline to gain traction in the region.
Super. Thanks for those insights, James. So Christina, Europe is kind of the heritage of Rede, and we have the largest team on the ground there. Can you comment on appetite and where you're seeing capital flow from Europe?
Yes, thanks, Scott. And look, obviously, compared to the other three regions that we've just been discussing, Europe is definitely much more mature. But we keep raising significant capital here, as you highlighted in your intro. So what is the key to this success? And as I look at what's been driving this, it really is four key sources of capital that stand out in this recent period. And I'll go through one by one. So one, it's the mature programs. We talked about this, but they're going through a bit of a rotation from some of their legacy relationships. So these are the names that many of you would actually recognize, and these tickets can be really chunky. However, I'd say these tickets are few and far between. So key here is that you need to be, of course, very connected to the senior individuals and key decision makers at these places. But then you have to couple that with a strong understanding of their overall portfolios so that you can actually advocate for what does make sense in terms of rotation, change, and where they should be doing that. Number two is new pension programs and other large allocators that are moving away from previously consulted relationships. These are less well-known names, but with significant capital to deploy in the coming years, and it's very exciting to see. Often, these teams actually come from other well-known LP programs, so it's people that we know well, and where these individuals are enjoying the opportunity, to be honest, to be starting from scratch, building a program from the very beginning. And here, therefore, it's very key and very crucial to be there in that early phase as they're planning, as they're thinking, and really be part of helping them in that, and obviously guiding them towards where those allocations should go. Number three is new family offices, one of our favorite topics over this conference, often with a PE link, as we talked about yesterday in the Rede View. So this group by number is by far the largest growing pool, and we're seeing these family offices pop up all across Europe. This is often what I'd say is smart money that are actively using us to get access to best funds, seeded portfolios, attractive co-invest, and GP-led. So it's really a solution provider for them and things that they can't really do on their own. And then the final group, fourth group, but by no means least important, it's the private wealth aggregators. These come in all shapes and sizes and are all trying to capitalize on the huge and increasing retail and high net worth appetite for private markets. Understanding what drives their own underlying growth and what's valuable to them specifically, this is what's really key here in terms of securing commitments.
Thanks, Christina. Sounds like a lot of really interesting developments in a mature market. So in terms of GP profile, for these sources of capital, what do you see most in demand?
Yeah, no, you're absolutely right, Scott, that depending on your profile, very different pockets will grant you a better hit rate than others. So if I take the rotation capital first, this is really going to today's mid-market GPs. So I'd say this is GPs that are on Fund 3+, have a track record with realizations, and ideally are, I'd say, in the 1 to 5 billion range in terms of fund size. If you look at the new, more traditional allocators, this I'd say is the best place if you are a larger fund. But at the same time, they are also looking to get capital into the ground quite quickly. So there is opportunities here for also smaller funds where there's a seeded portfolio and assets in the ground. If you're an emerging manager, I'd say family offices are probably your best bet in this group, at least, especially if you have a seeded portfolio or some assets there. And finally, if you're a specialist fund, you've struck bingo because you're attractive to all 4 of these pools for slightly different reasons, but you could probably fish in all 4 of them.
Great. And now, Alex, the other mature market and the deepest market, largest, is obviously North America. So what are the dynamics you're seeing here in North America?
Thanks, Scott. So yeah, so a few dynamics I'd call out here regarding sort of appetite and capital flow in North America, some of which, echo Christina's comments. I guess in terms of pockets of capital flow, it does fall largely into sort of 2 categories. The first is sort of new pockets. So this is something that literally never ceases to amaze me. North America is known and, is sort of the deepest pool of LP capital pockets. But nonetheless, there are always new programs to uncover in the region. I'd say currently that's most notable as a result of sort of RIA consolidation, new family office creation, and hospital systems moving towards endowment style investing. The other dynamic I'd call out here is just sort of pure portfolio rotation. Many mature programs are rigorously considering their roster of GP partners and closely evaluating if those partnerships still make sense and provide them with the exposure that they're looking for. In certain cases, particularly where the GP may have scaled significantly, that journey might be coming to an end. And therefore, LPs are really scouring the universe for their GP partners of tomorrow. In terms of appetite, we are seeing robust appetite and a lot of capital investing into funds. I'd say that's particularly true for buyout and in new relationships. In fact, actually, one really interesting dynamic that we've started to see sort of over the past year is there's some real anxiety from LPs who want to make sure that they're positioning themselves to secure allocations from those GPs that have been anointed as sort of the very best. Often these are Fund 3 situations where the GP has now secured sort of enough proof points, but is still hungry, the firm is still very much on its ascendancy, et cetera. The other thing I'd point out is we're also seeing robust activity from more sort of transactional LPs that are more about deal doing versus taking more traditional blind pool risk. So this is manifesting in the form of active interest in seeded portfolios, co-investments, continuation vehicles, et cetera.
Thank you. Alex, you commented on appetite for Fund 3s earlier. I wondered if you could comment more broadly on the appetite you're seeing for emerging managers.
Great question, Scott. So yeah, I mean, this is certainly top of mind for us at Rede as the bread and butter of many US LP portfolios is the US lower middle market. And there is sort of this seemingly near constant desire to find the best players in this space. In fact, Rede recently completed a survey about emerging managers, which we defined as Fund 1s to 3, sub $1 billion in fund size, to better understand exactly what LPs are looking for in this segment. The findings were quite clear. LPs are focused on this segment of the market because they believe they can find real alpha here. In fact, 66% of LPs surveyed are looking to this segment of the market to find GPs that achieve at least a 2.5x net return at the fund level. To determine this, the top 3 considerations when evaluating GPs are, unsurprisingly, track record, the strategy and fund size, and then team and pedigree. One sort of notably interesting point is on track record. Over 50% of LPs surveyed stated that they're looking for at least 3 prior round trip exits, and some wanting even more.
Thanks, Alex. Maybe switching gears now and turning to ESG, which came on the scene, at least a decade ago in Europe. But how are LPs feeling about ESG these days? And let me go to Europe and start with you, Christina.
Yeah, thanks, Scott. And as you say, ESG definitely a hot topic in Europe, has been for many years now. And it's honestly, it's with more and more rigor in how European LPs structure both their diligence and decisions around this topic. But maybe if I just take what this actually means in practice. So if you're a European fund today, Article 8 is really expected. Article 9 is still very much if you're an impact fund, and it's likely to stay that way. But Article 8 has gone from a nice to have to a must, and direction of travel is pretty clear there. For the non-European funds, there is more flexibility. But I'd say that European LPs do want to see a clear ESG agenda. And to be honest, that it's just something that really matters to you as a firm, right? And this often comes down to, are there roadmaps to keep improving on a yearly basis when it comes to ESG? Can LPs underwrite that direction of travel? And is that something that they're comfortable in doing? If I look at in terms of process, you should expect very detailed ESG due diligence today from the European LPs. This comes both in the form of questionnaires, which I'm sure you're all very used to, but also dedicated sessions, and often now with teams that are separate from the commercial team. Few of these teams today have a veto, but even this is something that we are seeing happening more. And maybe just my final thought on this topic is to highlight that these trends on ESG now are pretty widespread in Europe. It obviously is known to be very prevalent in the Nordics and Benelux, but it is definitely no longer isolated to those regions, and it really is across the whole region.
Great, thanks, Christina. And maybe now I'll turn to Asia Pac, a region not really known to have a leadership stance on ESG, but what's going on there now, Charles?
Yeah, you're absolutely right, Scott. And Asia actually really can't be painted with the same brush across the region. In fact, there are strongly ESG-leaning geographies today, like Singapore and Australia, New Zealand, where new allocation buckets are being created and approved purely for climate. And so these buckets can be across asset class. It can be across private equity, infra, structure, as well as venture to a small extent. Japan has always considered ESG factors in its investment underwriting. And so Japanese LPs are largely supportive, although a purely climate thematic is still somewhat new to people. So there can still be an elongated diligence process there. However, the rest of Asia appears to still be a little bit behind the curve, and wondering whether or not this is still charity capital or if outperformance is fictional. On the other hand, selectively, many later generational single family offices, I'd say, have a do good mantra. And so these family offices have a very clear path to invest in climate ESG. And really, I'd spotlight Singapore, which really must be applauded because its entire system, both government and commercial entities alike, have been at the forefront of reaching net zero carbon emissions. And so it's very admirable and a real hotspot as we're thinking about raising capital for climate. And lastly, parts of Australia and New Zealand, where whole organizations are now devoted to investing into the segment, see decarbonization not just as part of the future, but the future.
Super helpful. Thanks, Charles. I'd like to turn to LP process and conversion, what we're all after in this fundraising game. Conversion to commitment, that is. How are you seeing LP behavior evolve in terms of due diligence? And maybe I'll start with you, Alex.
Thanks, Scott. So at Rede, we really like to put ourselves sort of get into the head of the LP to drive conversion. We really want to understand, what is the LP trying to solve for in their portfolio? We want to understand why the LP makes the decisions that it does. And most importantly, and sort of pertinent to this question, we want to anticipate any issues that might derail an investment. So with that in mind, I would contextualize the current DD environment as one where the LP is much more concerned about what could go wrong versus the blue sky scenario. Why is this the case? I guess I'd say from our perspective, it's the case because overall, performance no longer has sort of the massive cushion built into it that was prevalent in most performance metrics a few years ago. So there's just quite simply like less margin of safety to rely on. On the investment side, I'd say there's a few key points of interrogation garnering more interest these days. So number one, does the GP have the right framework in place to not only do deals, but to also manage and optimize this portfolio? LPs want to see that their GPs have good discipline and process around creating meaningful value right out of the gates, as well as being thoughtful on when to sell or hold an asset. Number two, the question on people's mind is, does this GP have a right to exist in my portfolio? This comes down to, is the GP doing something that's truly sort of differentiated and interesting across sourcing, value creation, et cetera? And importantly, is this thing that the GP is doing something that's actually complementary to what's already in the LP's portfolio? Finally, I'd say the other area of heightened sort of focus in this environment is on people and culture. Really interrogating what are the sort of everyday habits and decisions that the people, and particularly the leadership at the GP, are making that culminate over years really to drive the performance results. So maybe, James, I'll turn it to you to comment from more of an operational perspective.
Thanks, Alec. And I'd agree with all of that. I think beyond the usual team track record, all the things that you'd expect LPs to focus on as part of the diligence, what we are seeing is greater focus on operational due diligence. And today, really most LPs are doing specific detailed on-site DD sessions to cover this, whereas in the past, it was certainly more a kind of tick the box exercise. As part of that, there's certainly much greater focus on alignment, team culture, governance, key person clauses, all these kind of things. But in addition to that, also spending more time with a broader team to corroborate and cross-reference what the senior team are saying.
Super. Thanks, James and Alex. Okay, I'd like to switch things up a little bit and change gears. We're going to go to what we call the round robin questions, which is one question for all of you, quick response. Okay, so let's kick off with this one. What do you see as the most interesting pocket of capital for you right now? And I'll start with you, Alex.
I guess I'd have to go with sort of the consolidated and increasingly sophisticated RIAs. Okay,
James.
For me, it would have to be Saudi family offices, which are still early in their adoption of private markets.
Aha. Christina.
Slightly biased here, but I'd say the Danish pensions.
Love the Danish pensions. And Charles.
It's got to be the newly forming sovereign wealth funds and pension systems that are coming into alternatives.
Okay. Next question for all of you. What do you predict could be an unexpected positive development in terms of capital flows from your region? In other words, a nice surprise. Same order. Alex.
I would say, I guess, regulation that opens the Brazilian pensions or quite frankly, the US 401k markets.
James.
For me, it's focus away from the mega cap brand names and finding the best lower mid-market opportunities, including emerging managers.
Okay. Christina?
Going for the wishful thinking, massive drop in interest rates.
All right. And Charles?
So the Islamic population in Asia is quite large, and its potential as a group really has yet to reach its full potential. So this is very exciting for us.
Okay, let me flip it then. What could be the negative surprise that you don't want to happen, Alex?
Heightened conflict in the Middle East.
Sure. James?
I'm afraid I have to agree with that one.
Okay, we'll give you that. Christina?
I feel I need to change my answer here, but I'd say carry tax spreading in Europe.
Okay, yeah. And Charles?
FX rates. Surprising on the downside against US dollar and euro.
Okay. Here's another one. We're all in the marketing and getting investors' attention business. What's your best emailing or networking trick of the trade? Alex.
I love a good short one sentence non-jargony email. I feel that's most effective to get a reply.
Okay, James.
I would say obviously pick up the phone rather than send an email. But if you are sending an email, let the subject line do the work. It needs to be crisp, clear, and to the point.
Yeah, Christina.
I'll go for the networking side of this. I'd say small local conferences, often where the magic happens.
Love it. And Charles.
I'd have to go with James. So I like to put in, can I give you a quick call on this later today? Gives a little urgency and just lets you connect real quickly.
Okay. One more round robin. What is the most original due diligence question you've ever heard asked by an LP? Alex.
I guess I was recently in a meeting with an endowment CIO, and he asked the GP, what do you do more creatively than others? And I really liked that question.
It's a good one. James?
I've only come across it once, but it's, if you're an animal, what would you be?
And what would you be, James?
Putting me on the spot, I hadn't really thought about this. I think it would have to be a falcon. It happens to be the symbol of courage and force in the region. So, falcon.
Love it. Christina.
I think my favorite is, so the LP asks, if you were an LP to the GP, which GP peer would you invest in? So figuring out who they're most worried about. I like it.
That's good. Yeah, Charles.
Well, I had an answer to the earlier animal question, but one of our colleagues would definitely be a turtle. But my answer really is it was probably jokingly, what is the ticket size that I can get a job working at this firm? Yeah.
Good. Well, look, I think this gives us some time now to turn to some Q&A. And the questions have actually been coming in. So let me go to the first one I see here, which is interesting to know. I'm interested to know if the panel is seeing increased interest for GP-led focused secondary strategies. Alex, would you like to take that?
Sure, happy to. So yeah, I would say yes. It's been sort of an interesting thing to watch the adoption curve of sort of GP-led secondaries. And now we are certainly seeing LPs, in some cases do them themselves, and then in other cases want to invest in sort of a vehicle that provides that exposure. And I'd say maybe the interesting development, even in the most recent period, is the sort of development of these CV funds, right? Fund of CVs that are not only just sort of going after the trophy assets from the blue chip fund, but actually now some really interesting groups that are looking for sort of the more challenged situations, the less obvious situations, and and actually bringing real sort of private equity investment talent to sort of prosecute those opportunities.
Great, thanks, Alex. Not to monopolize your time, Alex, but we've got somebody that's directed a question to you.
Oh boy.
So I'm going to ask it. Some stats came out today about the huge fundraising discrepancy between global flows into the US and the rest of the world. 6 times Europe, it was quoted. What's the current level of interest from US LPs into Europe? Up, down, flat in recent years?
Yeah, so I would say it is up versus, call it 2 or 3 years ago. And so that is sort of clearly something that our European clients are happy to see, and certainly something that's reflective in the capital that we've raised for our clients. I would say, that said, the data is quite clear that globally the sort of most interesting region for LPs is North America. But like I said, Europe is sort of moving up the charts again. And I think some of that, there's a few factors at play there. Some of it, if you just sort of think about, the past few years that we've all lived, people can get back on a plane again. They can go sort of really interrogate the opportunity set in the Benelux or, whatever it is. And so, that in and of itself changes the dynamic. I think the other thing is that you've seen just some really excellent sort of specialists, some really excellent performance out of the region. And so, again, when LPs, it doesn't matter sort of what region they're coming from, if they see something that's truly differentiated, that truly has a competitive advantage, that very clearly can generate some great returns, they're going for it.
Yeah. Great. Thank you for that. We have another specifically directed question to you, James, which is, please may you elaborate on the Saudi office opportunity. I think that means family office, Saudi family office opportunity.
Sure, Scott. I think looking at Saudi specifically, there is obviously a large concentration of wealth amongst family offices and ultra high net worth individuals. Part of that is obviously driven by the large concentration of conglomerates in the country and industrial businesses. And there's a bit of a bifurcation in this market between some of those family offices that have historically invested quite a lot in the local economy and have then turned to private markets slowly, investing predominantly in some of the largest kind of mega cap brand names, often through some of their feeder platforms. But beyond that and behind that, there is a huge amount of capital from smaller family offices that are yet to kind of penetrate private markets properly. And I think there's definitely an opportunity there to educate, particularly in terms of what private markets can bring to your portfolio, but also show them the breadth of opportunities that lie not just in those mega cap brand names that you can obviously invest in, but actually finding some more mid-market players that can deliver serious alpha to your portfolio as well.
Okay, great. We have another one from an anonymous attendee. Which European countries should we expect the most capital flow from in 2025? Christina, I'm going to direct that to you.
Yeah, thanks, Scott. And it's an interesting one. It does depend a little bit about you as a GP and the size of you. But I'd say if you're just talking general terms, we continue to see largest flows from, I'd say, UK and Benelux consistently ranked there. But there's also a skew towards ticket size, right? Because if you actually look at number of tickets and growing pools, Germany is extremely active, France is extremely active. And like I mentioned before, like the Nordics, I'd say generally speaking, although the tickets are quite big, is quite subdued across, but then Denmark is flying. There's lots of new capital there. So it does depend a little bit. And I think depending on how big you are as a fund and how far you've come in your maturity, there's different countries that you should be accessing and targeting.
Super. Thanks, Christina. We have a question from Miriam on what is the appetite you are seeing from your LP base for growth specialized funds focused on a single sector? Who'd like to take that and kick that off? How about you, Charles, and anyone else to chime in?
Yeah, thanks, Scott. I think specifically on specialist funds in healthcare and biotech, there's a very good family office base that is very focused on this opportunity, particularly in the US. Oncology is a big space to focus on, but binary outcomes there can be, there's a little bit of pause to consider. But generally there is, family offices are leaning in heavily.
Thanks. Any other comments on specialism, Alex?
Yeah, I mean, I would say, look, within, basically any segment, right? It could be venture, it could be growth, it could be buyout. We are seeing just this heightened focus from LPs for GPs to really define like what it is that they do uniquely. Why do they get better deals? How can they create value better? All of those things. And so, if you sort of think about, specifically this question on sort of specialism and growth, it's no different. We LPs do want to see that, and again, really, it really sort of underscores the importance of this point around like LPs want to. There needs to be sort of a right to be in a portfolio, and if you are sort of generalist and do things kind of like others, that right is really hard. That case is really hard to make. But if there's something really nuanced, specialized, it's a little bit easier. The one caveat I'd say is, in general, specialization is good. Sometimes if it's too hyper specialized and narrow, it can feel slightly irrelevant to LPs. So it's sort of walking that balance.
Yeah, and I just make a follow-on comment on that, just in terms of examples of specialization. I think what we're seeing also is going from a broad sector to even subsector specialization, particularly within areas like healthcare and tech services. So that's been quite interesting to see. Okay, let's have one other one going back to due diligence. There's a question here asking for comment on due diligence, deep dive access, differentiation around LP ticket size. James, do you want to take that?
Sure, I can take that, Scott. Look, I think it really depends on the fundraising dynamics, right? And I think, as everyone probably on this call knows, it's been a very challenging fundraising environment. I think two observations I'd make. So certainly GPs are in very strong positions. They're getting creative around how they think about this and often kind of hosting multiple LPs in single DD sessions and things like that. I'm personally not a huge fan of that. But I think you can be creative at times if needs warrant and the ticket size is appropriate. I think the other aspect I'd talk about is generally GPs are more accepting of smaller tickets in this market. And I think when there is a path to scalability over time, there may be specific reasons why certain LPs can only make certain size commitments today, given their own capital constraints, but may be able to scale significantly in the future. So I think it's important to take that into account and the strategic value that each LP can bring beyond just capital.
Thanks for that, James. Well, look, we're coming up to 5 minutes running over, so I think we're going to wrap now, although there are some great questions coming in, and maybe what we can do is try to catalog some of these and get back to you that have identified yourselves. Or also feel free to get in touch with any of us or send things in through our website email. But this has been really fun for us. Thank you all for your attention, and I hope you enjoy the rest of our programming at RedeConnect. Have a good day.